This is how China turned American tariff threats into a record-breaking $1.2 trillion trade surplus in 2025. While Washington expected those tariffs to cripple China's economy, Beijing just achieved the largest trade surplus in its modern history. Here's the headline that should have shocked everyone. China's trade surplus hit $1.189 trillion in 2025. To put that in perspective, that's more than the entire GDP of most countries. But here's what makes this truly remarkable. This happened during what was supposed to be China's economic reckoning. The tariffs were supposed to bring manufacturing back to America. They were supposed to make China hurt. Instead, China just had its best year ever. Throughout 2025, China consistently posted monthly surpluses exceeding expectations, with several months breaking the $100 billion mark. This wasn't just a lucky quarter or temporary bounce. This was sustained strategic execution under what should have been crippling pressure. In November 2025, just as China's trade surplus was reaching these historic heights, the US and China reached a one-year trade truce. Tariffs that had escalated to a staggering 125% were reduced back down to around 47.5%. Both countries stepped back from the brink of total economic war. This truce was supposed to bring stability. It was supposed to signal that cooler heads had prevailed and that both nations recognized the damage they were doing to the global economy. But that stability might be short-lived. In January 2026, President Trump announced 25% tariffs on any country doing business with Iran. Here's why that matters. China is Iran's largest oil buyer. This new policy could restart the entire tariff war just months after the truce. Economists are warning that if both sides retaliate again, we could see tariffs spike back to 145% or higher. So we're sitting on a knife's edge. China just proved it can thrive despite tariff pressure, and now there's a very real chance that pressure is about to return with a vengeance. While China's exports to America were indeed declining, down about 20% for the year, something else was happening that completely changed the game. Chinese companies weren't just sitting there taking the hit. They were playing chess while America was playing checkers. The pivot started in earnest right after Trump's election victory in November 2024. Chinese exporters and multinational companies operating in China began systematically shifting their supply chains away from American markets. This wasn't random. This was coordinated, strategic, and ultimately devastatingly effective. Here are the numbers that tell the real story. Exports to Africa increased 26%, Southeast Asia increased 13%, and Europe increased 8%. China didn't just replace American demand. They expanded their total market reach. They used the tariff pressure as motivation to diversify their customer base in ways they might never have done otherwise. By the time 2025 ended, China's total exports had grown significantly, while their imports stayed relatively flat. That means all of this surplus was pure wealth accumulation, money flowing in, nothing additional flowing out. Let's talk about what this really means, because this story goes way deeper than trade statistics. American tariff policy was based on a fundamental misunderstanding of how modern supply chains work. The assumption was simple: make it expensive for China to sell to America, and either they'll lower their prices to compensate, or American companies will find alternatives. What actually happened was neither. China didn't lower their prices and absorb the tariff costs. Instead, they found new customers, lots of them. The ASEAN countries, Thailand, Vietnam, Malaysia, Singapore, Indonesia, were happy to buy Chinese goods. So was Europe. So was basically everyone except America. This reveals something crucial about the modern global economy that most people don't understand. When you're the world's manufacturing hub, when you've spent decades building the most sophisticated production capabilities on Earth, you don't just lose that overnight because one customer gets upset. You find new customers. Think about this from a business perspective. If you're a Chinese manufacturer and you've been heavily dependent on American orders, those tariffs were terrifying. But they were also clarifying. They forced you to ask, why are we so dependent on one market? Why haven't we developed stronger relationships with customers in Southeast Asia or Europe or Latin America? The tariffs essentially forced China to build a more resilient, diversified export economy. In trying to hurt China, American policy actually made China stronger and more independent. Now let's talk about what this means for you, because this story has massive implications for anyone trying to navigate the current economic environment. First, if you're worried about inflation, pay attention to what's happening here. China's massive trade surplus means they're accumulating enormous amounts of foreign currency. That gives them significant economic leverage and helps stabilize their currency. A strong, stable Chinese economy affects global commodity prices, shipping costs, and ultimately the price of goods everywhere. But there's a flip side. China's relatively flat import growth suggests their domestic economy isn't consuming as much as they're producing. That excess production capacity has to go somewhere, and increasingly it's going to non-American markets. This could create deflationary pressure in those markets, while potentially keeping prices higher in America. If you're thinking about investments, this data suggests a major reshuffling of global trade relationships. Countries in Southeast Asia and Europe are becoming more important to China, which means more investment, more infrastructure development, and more economic integration in those regions. American investors who are only focused on domestic markets might be missing significant opportunities. For anyone worried about job security, the picture is complicated. The tariffs didn't bring manufacturing back to America the way they were supposed to. Instead, they pushed Chinese manufacturing to become more efficient and more globally integrated. That's not necessarily bad news for American workers, but it does mean that protectionist policies aren't working the way politicians promised they would. Here's another angle that most analysis misses completely. China's record trade surplus happened while they were dealing with significant domestic economic challenges. Their real estate market was struggling. Consumer confidence was shaky. Local government debt was a major concern. Yet they still managed to achieve this historic export performance. What does that tell you? It tells you that China's economy is more complex and resilient than the simplified narratives you hear in American media. It tells you that while they certainly face challenges, they also have capabilities and adaptive strategies that are consistently underestimated. This matters for your personal financial decisions because it affects everything from currency values to commodity prices to global supply chain stability. If you're making investment decisions based on the assumption that China's economy is fragile or declining, you might be working with outdated information. The speed of China's adaptation should tell you something important about competitive positioning. In the modern economy, the ability to quickly pivot, diversify, and adapt to changing conditions might be more valuable than any traditional competitive advantage. China demonstrated that capability at a national scale. But let's talk about the import side of this equation, because it raises some important questions about what's happening inside China's economy. Import growth was relatively weak throughout the year, consistently underperforming expectations. This suggests that while Chinese companies were aggressively pursuing export markets, they weren't increasing their purchases of foreign goods at the same rate. There are several ways to interpret this. It could mean that domestic Chinese demand is weaker than export demand, which would be concerning for global companies that sell into the Chinese market. It could mean that Chinese companies are being more conservative about inventory and capital expenditure, focusing on cash generation rather than expansion. Or it could mean something more strategic. If you're facing potential trade tensions and policy uncertainty, building up cash reserves and foreign currency holdings while minimizing dependencies on foreign suppliers starts to look like smart risk management. This pattern, strong exports and weak imports, creates a massive trade surplus, but also reveals potential vulnerabilities in China's economic model. An economy that produces much more than it consumes domestically is inherently dependent on external demand, but China's success in diversifying that external demand reduces the vulnerability significantly. Now, let's project this forward, because understanding where this trend leads is crucial for anyone making financial or business decisions today. What the data suggests is that China has established a new baseline for export performance that's significantly higher than their historical average. This new baseline reflects structural changes in their export economy, better diversification, stronger relationships with non-American markets, and more sophisticated supply chain management. These aren't temporary advantages that will disappear when trade tensions ease. These are permanent improvements to their competitive position. For American policymakers and businesses, this presents a challenging reality. The tariff strategy not only failed to achieve its stated objectives, it actually strengthened China's position in global markets. China is now less dependent on American demand and more integrated with the rest of the world economy. And with the new Iran tariff threat looming, we might be about to see round 2 of this economic experiment, except this time China enters from a position of proven resilience and global diversification. If tariffs spike again, they've already demonstrated they can adapt and thrive. This has implications for future trade negotiations. China enters any future discussions from a position of greater strength and less vulnerability than when the tariff war started. They've proven they can maintain economic growth and export performance even when facing significant pressure from their largest historical customer. Let's zoom out and talk about what this means for the global economic system, because the implications go far beyond China and America. We're seeing the emergence of a more multipolar trade system. Instead of everything flowing through the US-China relationship, we're seeing stronger direct relationships between China and Southeast Asia, China and Europe, and potentially China and other regions. This reduces American leverage over global trade flows, but also potentially reduces systemic risk by creating more diverse trade pathways. For individual investors and business owners, this suggests opportunities in companies and markets that are positioned to benefit from these new trade flows. Southeast Asian economies that are seeing increased Chinese investment and trade could offer significant growth potential. European companies that are building stronger relationships with Chinese suppliers and customers might outperform competitors who are more focused on American markets. The tariffs accelerated China's transition from an economy dependent on American demand to an economy integrated with diverse global markets. That's a strategic improvement for China that will have lasting effects regardless of what happens to the tariffs themselves or whether they come roaring back because of Iran. For Americans, this means that economic nationalism and protectionist policies carry significant risks of unintended consequences. In trying to use economic leverage to change Chinese behavior, American policy may have actually reduced American economic leverage while strengthening China's position. This doesn't mean trade policy is unimportant or that economic relationships don't matter. It means that in a complex global economy, simple solutions often create complex problems. Tariffs designed to hurt China's economy may have ended up accelerating China's economic development and diversification. The lesson for individual decision-making is that you can't assume that economic policies will work the way politicians say they will. You have to watch what actually happens and adjust your strategies accordingly. The data shows clearly that China's economy adapted to tariff pressure much more successfully than most experts predicted. Looking forward, the key question isn't whether China can maintain these trade surplus levels. They probably can, at least for the next several years. The key question is how other major economies will respond to China's strengthened position and diversified relationships, especially if the Iran tariff threat reignites the trade war. Europe, Southeast Asia and other regions that are benefiting from increased Chinese trade and investment may become more resistant to American pressure for economic decoupling. They have their own economic interests, and those increasingly include strong relationships with China. For you, as someone trying to make smart financial decisions in this environment, the key insight is that the global economy is becoming more complex and multipolar. Investment strategies that assume continued American economic dominance may miss significant opportunities. Business strategies that assume China's economy is fragile or declining may be based on outdated assumptions. The China trade surplus story reveals how quickly economic relationships can change and how important it is to base decisions on actual data rather than political narratives. China turned what was supposed to be economic punishment into economic opportunity. Whether you see that as good news or bad news depends on your perspective, but understanding it clearly is essential for making smart decisions in an increasingly complex global economy. The numbers don't lie. China made $1.2 trillion in 2025 while facing significant trade pressure. They did it by being more adaptable, more strategic, and more globally integrated than their critics expected. And now, as new tariff threats emerge, they're positioned better than ever to weather whatever comes next.